issue. The Federal Reserve decision just around the corner, and the whole market waiting for one thing: guidance.
It's time for the Fed to give some communication.
We shouldn't expect much today, actually.
With the four guidance we've given already, it's not necessary to do something to emphasize that forward guidance.
We really think that they'll continue their dovish stance.
I sincerely don't expect the Fed to back off at all.
If anything, they will probably acknowledge that maybe the outlook is a little bit better.
There are many tools that they can use.
We're going to use those and deploy those tools as effectively and powerfully as we can to support the economy.
I don't know if the Fed's ammunition is really limitless.
We crossed a lot of red lines that had not been crossed before.
We're in new territory here.
Looking for forward guidance a little bit later from the Federal Reserve. One man also looking for the same thing as Bloomberg's Michael McKee joins us now. Good morning to you, Mike. Your thoughts on what you are dialing in on and what we should be looking for a little bit later this afternoon?
Well, John, for those who were looking at the jobs report as potentially good news, here's where we are this morning. The OECD out of Paris out with a new forecast for the global economy and for individual countries, the worst recession in 100 years. Take a look at that chart. The OECD sees the U.S. shrinking more than 7% this year, and that's if there's only one wave. The Euro area, 9%. Italy, France, the UK, more than 11%, and it would all be worse if there's a second wave. That's the backdrop to today's decision. Data out this morning reminding us of the hole that we are in. China out of the virus crisis, their economy reopened, but factory deflation deepening in May. The PPI there, a coincident indicator for production in China, declined down to 3.7%. Their consumer price index rose. Ours did, but just barely. Consumer prices holding just above deflation. 0.1% on a year-over-year basis, lowest since 2015. And remember, the Fed targets the PCE, which generally runs 4 to 5 basis points below CPI. Are we looking at deflation? Gasoline was down 3.5%, apparel down 2.3%, airline fares down 4.9%, pushing our rates below. So, the Fed. Rates are at zero. 9 lending programs stood up. Nothing more expected today. It's a meeting for maybe taking stock rather than taking action. But what does Jay Powell say about the future? Your guests earlier saying they want guidance. Well, we'll get their first forecast since December. Look at how quaint those numbers are. How bad will the numbers today be? They thought GDP would grow 2% this year, 1.9% next year. Unemployment, 3.5%. Yeah. Do they match the OECD concern today, and do they scare the markets? What does Jay Powell says? You could be at zero forever. Another aspect of this whole thing today is the Fed blowing a big bubble. When you look at stocks, is it worth this kind of low rate forever? Those are questions to put to Jay Powell. Also, are they widening inequality? Is that worth it? A lot for the Fed chairman to face this afternoon. A lot of questions in the markets and around the world, John.
Looking forward to that news conference a little bit later, Mike. And just to pick up on what you had to say about the projections, as you point out, we haven't had any since December. And this is not a criticism of the Fed. Nobody saw the revisions that they would have to make 6 months later. But if you knew, would you have guessed that the market would be higher now than it was back then when those projections were made? And I think many people would not have, Mike. So let's talk about financial conditions. How do they tread that very fine line between being downbeat on the economy, projecting comfort and support, without really pushing people to take more risk at a time when this market is functioning in a much, much better way than it was just 2 months ago?
Well, I think you've got to ask the question of, can the Fed do anything different? Not what should they do different. Their problem is they're very binary, and we had former New York Fed President Bill Dudley say that the other night. They have only the one tool, interest rates, which they can manipulate in different ways by lowering Fed funds or doing QE or whatever. But are interest rates going to solve that problem? At this point, if they take interest rates higher to try to calm market speculation, then what does that do to the economy? That's the kind of decision that they're facing.
Michael McKee on the blunt tool of monetary policy that has done a heck of a lot over the last couple of months to support this economy and to support these markets as well, perhaps a whole lot more so. On the projections, here's Lindsay Piegza of Stifel running the following. The Fed can have bleak forecast figures but soften the blow with upbeat rhetoric and a longer-term outlook for recovery. Let's bring in Lindsay right now. She joins us on the phone. Lindsay, fantastic to catch up with you. Let's talk about the guidance. The forward guidance that you're expecting to see a little bit later and how formalized that might be from the FOMC. What are you looking for?
Well, I don't expect official formal guidance, but I do expect the Fed to take a more reassuring tone, reminding investors and the average American that the Fed has taken already extraordinary action, the action that was needed to be taken to soften the brunt of the pain in the first quarter, in the second quarter. But also, I do think that Jerome Powell is going to take this opportunity to remind investors that the Fed's toolbox is far from empty, that there still remains a tremendous amount they can do to help continue to soften the blow should things turn for the worst going forward then into the second half of the year. So if we see more pain, the Fed is willing and able to step up with additional policy support.
Well, Lindsay, let's talk about objectives. Pre-COVID, the objective was to extend the cycle. When we had the market rout, it was quite clearly about market functioning. Now we enter a new phase of monetary policy. What's the new objective? The current New York Fed President, John Williams, actually said to us on this program a couple of weeks ago that they'd be looking to get this economy back to pre-COVID-19 levels. Do you think that will be the objective for this Fed? And will they communicate it that way?
Well, I think the Fed has already communicated that they're going to remain very accommodative until they get the economy back on track, at least towards that that pre-corona pace trend, meaning 2% inflation, 2% growth. So it doesn't necessarily mean that policy will remain steady until we reach that, but until we're back on a pathway clearly headed towards those objectives. And that means, in our opinion, that the Fed remains at these extremely low levels for essentially as far as the eye can see. We do not see the Fed communicating any sort of policy move, certainly not this year in 2020, but not in 2021. 2022 is really the earliest that we can expect the Fed to even think about moving off of these low rates.
Well, let's talk about expectations, where you expect that long-term dot on the dot plot to come down to. Where do you expect it to be after this meeting today?
I don't expect much movement in the dot plot. I do think that the Fed is, again, going to remain committed to this low interest rate policy for as long as needed to get the economy back on track. So what is the next directional move for the Fed? We do think it will be a rate hike, but I don't know if the dot plot will be able to reflect that timing, given that it only looks out 24, 48 months. We could see the first policy move well beyond that. So it remains to be seen.
Well, let's be clear, Lindsay, you don't expect the dot plot to move that much. The long-term dot right now is at 250. Fed funds is near zero. You think it hangs out near 250?
I do. I do. I think the Fed may communicate a continued stale policy position for quite some time. Again, right now, the Fed is trying to communicate a tone of reassurance. And a lot of that reassurance comes from the fact that the Fed is going to remain accommodative. It's not necessarily a reassurance from unrealistic, rosy forecasts. But again, that the Fed remains committed to continue to keep policy at these low levels to get the economy back on track. And I do think that's the reassurance that they're going to try to communicate in the dot plot.
Before we let you go, you said the Fed's not out of tools. One of the tools that many people think they might reach for is yield curve control. We've had several Fed officials on this program over the last couple of months. We've discussed it with them. It's certainly clear they're thinking about it. Do you think this meeting is a little too early to get that one out the door?
I do. Yield curve control is certainly something that Fed officials are thinking of and arguably have already unofficially implemented. You look at how range-bound yields have been, particularly the 10-year, and you could argue that yield curve control is already in place. But again, I don't expect Fed officials to announce any sort of official policy change today. But of course, going forward, should we need additional support for the market or, again, that reassurance that we talked about, the Fed certainly would be willing to formally introduce yield curve control, targeted QE, or other tools available for policymakers to continue to implement action that would keep the market on track.
Lindsay, thoughtful stuff. Much more still to come on this program. Our thanks to you first, Lindsay Piesa of Stifel. Up next on this program, Jim Bianco of Bianco Research, a Federal Reserve critic on all the work they've done over the last couple of months. And a message he reflects on Goodhart's law. When a measure becomes a target, it ceases to be a good measure. We'll talk about a whole market that's become a target for this Federal Reserve, and we'll do that next. From New York.
of health resources, because the sooner you beat the virus, the less expensive the recovery will be, and also you'll be able to cure the consequences of the virus itself in terms of unemployment and other sequels that it will leave us.
Anhel Gurria, good morning from New York. I'm absolutely fascinated what Laurence Boone and others say at OECD about the amount of fiscal stimulus as compared to GDP. The variations are extraordinary. Who's getting fiscal stimulus right?
The question is that in many of these cases, what you call, government stimulus is, to a very great extent, guarantees or liquidity or loans, and therefore those will not become what I would call deficit numbers, or they will not become fiscal officially until there is some kind of payback, or in some cases the facilities are built to become deficit to the extent that, for example, the companies can maintain the employment. Those are meant to become, basically taken up by the government. But in many cases, in most of the cases, these large amounts, 20, 25%, 30% of the GDP, are meant to be paid back to the banks or to the development banks, and they're only guaranteed by the government. So the numbers are not comparable in that sense. If you take what I would call the hard expenditure measures, then that changes all over the place, from very little to very large.
Anhel Gurria, you are truly one of the experts in the world on your Mexico, on Latin America, and indeed the challenges of South America. The pandemic statistics from Mexico South are horrific, led by Chile, which is just simply falling apart. What does OECD think needs to be done to assist a greater South America in turning around this crisis?
Well, first of all, they need to be aware, and that means the leadership has to share these views. They have to act accordingly and within the constraints that they have. Within the constraints, this is very important, to then apply measures like confinement, social distancing, etc. The question, again, will not be solved until we have a medicine or we have a vaccine. But the problem in Latin America, Tom, and the problem in Africa, and the problem in Asia, is that it's very difficult to confine these people. They live in very close quarters, very close proximity. They have to go out every day in order to make a living. That makes it more difficult.
What does that mean, Anhel Gurria, about the prospect for emerging markets over the next 12 months?
It means, because they're going to be hardest hit, and we always said this, the problem with this crisis is that, again, the most vulnerable are the hardest hit. And that includes the people, but that also includes the countries, the groups of society. And it means that their growth is going to be affected, and that also not only as much as the developed countries, OECD countries, but also that the impact will linger for longer. That is aggravated by one particular element, which is very high levels of informality. So even if you have the capacity to write the checks to all these people, you wouldn't even know where to send them, because half of the workforce are not registered anywhere. They're not paying taxes. They're not on the Social Security, etc. So that is a very, very great problem.
Anhel Gurria, when you look, we've never really seen a crisis like this, right? It's a health crisis that also turned into an economic crisis. So I guess it's finding the right balance between saving lives whilst at the same time reopening safely an economy. Who's getting it right? Who do you point to and say, they have the right mix on how you do this?
Francine, the choice between lives and livelihoods is a false dilemma. The health and the economy go hand in hand, and you have to fight the pandemic first, as I said, with everything you got. You throw everything you got at it, and then that will allow you to beat that enemy first, and then that will allow you to pay a lesser price or lower price for the consequences of the pandemic itself, but also to set up the basis for a sound recovery going forward.
And obviously it's semantics in some ways, but it does matter in terms of sort of how investors think about the markets and what investors do in that market. So the relevance of saying this time it really was different. Walk us through your thinking.
Well, the bear market lasted from February 19th through March 23rd. So it only lasted 33 calendar days, and that was actually 23 trading days. And of those 23 trading days, during 7 of them, the market was down 20% or more. So it really was basically a 7-day bear market. I don't really believe that that should be included in the record books as a bear market. It's really more like a panic attack. And I think the relevance is, if in fact it was a bear market, and that's the way you want to look at it, then I guess the question is, was this rally just a rally in a bear market? I don't think so. I think it was a continuation of the bull market that we had that started way back in March 2009.
What on earth is the justification for this, Ed? I mean, fundamentally, the economy is, just in a deeply bad state. The Atlanta GDP now figure improving, but still at minus 48% for GDP. And then when you look at earnings, we just had Bruce Richards talking about potentially year over year next quarter down 30%.
Sure. Well, you're right. I mean, from a fundamental perspective, you can say that it's a bear market because bear markets occur during recessions, and there certainly has been a recession. And as a matter of fact, the National Bureau of Economic Research just declared that the peak in the longest economic expansion of all times occurred in February. Some of the press has been picking it up, saying that the recession started in February. It actually started in March. But you know what? It may very well be over in May or June. I mean, in some ways, this is more a natural disaster than it is a classic recession caused by credit crunches and all sorts of other excesses that lead to a significant and long decline in the economy. This could very well be the shortest recession of all times. Basically, it would cover the second and the first quarter and the second quarter, but in terms of the monthly pattern, it really took a dive in March, and that was just the last 2 weeks of March. And then April, it took an even bigger dive. That's when we lost just about all of the. That's where all the negatives came in. But we're starting to see some indicators bottoming in May, and the outlook is that many of them will bottom in June.
We are seeing, Ed, obviously a kind of a rotation into the businesses that will lead us into the future. We're seeing the NASDAQ here breaking 10,000, that NASDAQ 100 for the first time pass in history. As a longtime watcher of these markets, I just want your kind of check on valuation here. And in the context of, we had this sharp, issue we had to get past. We could even go back to January. What do you make of the value of these markets?
Well, very often you do get melt-ups in bull markets, and they usually occur near the tail end. But everything is sort of all over the place in terms of comparing what's going on now to the past. Let's just say that the bull market that started in 2009 is still intact. We may actually be seeing the melt-up phase in the market. I hope not, because if this thing becomes too much of a bubble, then we're going to have a whole other problem within the next 6 to 12, 18 months. But valuation is not cheap. But it's hard to measure valuation off of actual earnings right now because actual earnings are taking a dive. The market is clearly looking beyond the abyss right now. And the market is basically saying that for all the terrible things that have happened, the underlying earnings capacity of most companies has not been affected, that they are going to come back able to earn what they were earning back in late 2019 without that much duress.
I guess one of the questions that would upset that progress back to kind of where we were is indebtedness, especially on the consumer side, that would tip people over into bankruptcy. That this would be kind of the last straw, these few months interruption. You're not fearful of that?
Right. Well, I think there are going to be some aftershocks from what I call the great virus crisis, and the aftershocks will very much be in the areas of debt problems, because clearly there are going to be a lot of businesses, particularly small ones, that are going to be very happy to be reopening over the next several weeks, but they will be restricted in how many people they can actually have in their establishments, which means that they really have to control their costs, or else, 50% just capacity isn't just going to make for a good business for a lot of these companies, and so there could be a wave of distressed companies. But keep in mind, the Fed hasn't even started to make out something like $4 trillion worth of loans to Main Street.
Yeah.
This whole recovery is all about the Fed, and the Fed isn't done by a long shot.
No, and in fact, they're actually speaking in Washington as we speak, Ed, and we'll get another statement tomorrow. Do we start to inch towards yield curve control?
I don't know that we're going to need it. I mean, they're basically controlling the yield curves simply by their quantitative easing program. I guess we're on QE4. I call it QE forever. And there's just an open-ended commitment to just keep buying securities. And that's certainly done a very good job of keeping the bond yield under 1%. I guess if they feel like the markets are fighting them and they need to keep that yield under 1%, they could announce that they're pegging the bond yield at below 1%, but I don't think it's really going to be necessary.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan, and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson
There are thousands of patients now complaining of the fact that they have persistent symptoms. The fever goes away, and all the other symptoms, the cough and other things, and now they're developing other kinds of symptoms. The more common ones seem to be that they have this brain fog, this chronic fatigue, malaise, lymphadenopathy. So these symptoms are reminiscent of what we call as ME/CFS. And that's not all that surprising because a lot of viral infections have been associated with this syndrome. These things are happening later in the course of the infection, suggesting that there's an immune component to it. So, the virus goes down and the immune system gets hyperactive, and it can cause a variety of different types of neurological symptoms.
met through jivansati.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. GS10.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen that shift from traditional caste community conservative parameters to something like which is more focused on education, employment.
Anshu and Sumit's marriage was initiated by their parents, but modern Indian couples like them have more input than previous generations.
We looked up to them to agree for the proposal, but it was primarily our decision that we wanted to be with each other.
So what's the emoji like you use the most to send to each other?
So there's a bear which basically we use for indicating a hug.
Half months after they first met online, the couple got engaged. They decided to hold their wedding less than 3 months later. But planning a traditional Hindu wedding on such short notice is no easy task. The massive event usually lasts 3 days, has various ceremonies and celebrations, and involves the entire two families and hundreds of guests. Luckily, there are websites and apps for that.
We searched online, we got in touch with Wedding Brigade and they helped us finalize the venue, and it makes the search faster and efficient.
Services from booking banquet venues to buying wedding gowns. The website makes money by charging commission from vendors.
People don't want to be limited to what is available around them. They want to know the entire range of options available before making a decision. And now it's easy to find almost everything on one portal.
mile long to own that because we've all had huge gulps of it, me included.
All right, joining us now is Katie Koch, Goldman Sachs Asset Management Co-Head of Fundamental Equity. Katie, your title says it all, fundamental. How are you handling these market moves over the last few weeks?
First of all, Alex and Guy, thank you so much for having me on the show. I'm really delighted to be here. Just by way of background, we're very long-term investors. And I would say that even with that posturing, one is able to win because the vast majority of our strategies this year are outperforming markets. It's actually been a great environment for selectivity. So maybe first we'll address a little bit of that activity in the retail market and some of those dislocated names. And I can hit on some of the stuff that we like from a secular perspective that's also cyclically dislocated. So we acknowledge the hyper activity of the retail investor. I would just highlight that the retail investor is actually still in net outflow in terms of equity flows on the year, but there's been a high recycling of the asset base. And just to give people context on volumes, if you look at Ameritrade data, they came out a couple of days ago. They're showing an average of 3.3 million trades being executed a day for retail investors and volumes running up 300%.
That's exactly what we're looking for, and looking to see, the asymptomatics would be really interesting. And that's why we're giving away kits, because those people are so hard to find.
This election was not without controversy, and I'm so proud that London has today chosen hope over fear and unity over division.
After taking the mayor's office with a comfortable majority, Khan has brought a business-like efficiency to the role, scrapping expensive vanity projects like the Garden Bridge and the new Routemaster buses, which cost £350,000 each. The former lawyer who used to fight the police in court is now praised for his close relationship with them.
I was talking to a very senior police officer in the Metropolitan Police who said there was a sea change when he went into City Hall, and the police were saying how much they welcomed this because they knew where they stood and it was more straightforward to work with. So he works like a lawyer, he works like a government minister.
Khan's kept his faith at the fore. He's an outspoken voice for moderate Muslims across the world.
Donald J. Trump is calling for a total and complete shutdown of Muslims entering the United States.
Now, by giving the impression that Islam and the West are incompatible, you're playing into the hands of the extremists.
Good morning, everyone, and welcome to the first trade on Yahoo Finance for this Tuesday, June 9th. I'm Alexis Christophers, along with my co-anchor, Brian Sazi. Thanks so much for being with us today. Well, it looks like after yesterday's incredible stock market rally, investors are taking some profits today. We've got stock futures lower across the board. Dow futures now down about 1%. But the real story here is the market's jaw-dropping gains, even in the face of an unprecedented pandemic and now civil unrest in our country. Since its low in March, the S&P 500 is up 44.5%. It is now positive for the year. The Dow up a staggering 48.3%. And the NASDAQ has rocketed nearly 45% to its first record close in about 4 months. And new data shows that it is the retail investor, not the institutional investor, who is driving this stock market rally. Investors seem to be unfazed by news that the U.S. officially entered a recession in February. The National Bureau of Economic Research said the economy reached a peak in February, marking an end to the longest economic expansion in post-World War II history. But the group said the downturn may actually turn out to be briefer than past recessions. Jared Blickery joining us now for a closer look at the stunning stock market performance. And Jared, I also want to bring to folks' attention that in another positive sign, the rally is not just concentrated in those big name tech stocks. There's sort of been a breadth to this market rally. Tell us why that's so important.
Yeah, that's a development that just started happening about 17 trading days ago. And that was the beginning of this latest leg up. And if we look at a chart of the S&P 500 year to date, I can illustrate what we're talking about here. Now, the first leg of this rally off the lows was largely driven by tech, the mega caps that we talk about, the FANG stocks, and not a lot of participation, a lot of broader participation. And then we kind of went sideways in here for about a month and a half, and it looked like the market wanted to roll over. But then all of a sudden, we got these cyclicals and value stocks like energy stocks, industrials, financials for that matter, all driving higher. And so this latest leg, 17 days old now, 17 trading days, has seen broad participation. And it is fitting that the very day that the S&P 500 goes positive, albeit only by 5 basis points, we found out that we were in a recession, but not a lot of big news there. And just looking at the sector performance over the last 17 days in this leg, we can see energy up 30%, financials up nearly 30%, along with industrials, real estate, staples, and a discretionary. And then to the downside, healthcare has been lagging along with the tech sector. We see it's only up about 11%. Now, can the market go higher? Of course it can, but it looks to be a little overbought right now, and we have that big Fed meeting tomorrow, so we might be taking a pause right now.
And Jared, we're seeing these retailers continue to rally. JCPenney, which is now bankrupt, Their stock up 96% yesterday. Yet Macy's stock continuing to rally. You know, they came out with a new debt raise, but still the retail rally is strong.
Yeah, this is one of those signs of froth that we're seeing right now. I've compiled a heat map of a bunch of companies that have either declared bankruptcy or have been rumored to be about to, and you can see the performance. This is one-day performance as of yesterday. Hertz up 115%, Chesapeake, an energy company, up 182%, Whiting Petroleum, which has been in bankruptcy for months, up 150, J.C. Penney here, up 95. And if we look over the last 5 days, we can see this latest surge is just absolutely stunning. Hertz is up over 500%, for instance. But if we add the pre-market quotes to these, we can see that there is a lot of profit taking right here. We can see Chesapeake is already down 47% in the pre-market.
Yeah, thanks, Jared. Stunning is definitely the word. And, and another sign that this market is really coming back to life, the IPO market is showing a lot of momentum. It looks like we're getting new S1 filings just about every day. Emily McCormick has been keeping an eye on this. And Emily, today the spotlight belongs to Vroom, the online automotive company. I understand they priced their IPO at the high end of the range last night. What else can you tell us?
Absolutely, Alexis. So we are seeing a renewed appetite for newly public companies recently, and Vroom is no exception. So we had that online car retailer pricing its IPO yesterday. That was actually 2 days earlier than initially planned, given this recent rush to hit the public markets. So Vroom's was an upsized IPO, with the company selling more than 21 million shares for $22 each and raising a total of $468 million. This was upsized, as I mentioned, since Vroom had earlier marketed 18.75 million shares for between $18 and $20 a piece. Now, following this offering, the company is valued around $2.5 billion. Taking a look at the financials of this company, Vroom is unprofitable but growing on the top line. It posted a net loss of $41 million on sales of $376 million for the 3 months ended March 31st. That was wider than the net loss of $27 million in the same period last year, although sales were also up 60%. Vroom mentioned in its prospectus that it's expecting the COVID-19 pandemic will encourage customers to buy cars, especially using online platforms to maintain social distancing. And those shares are expected to begin trading today on the NASDAQ under the ticker symbol VRM. And the last thing I want to point out is that we have seen a major uptick in initial public offerings and other listings over the past couple of weeks. Last week was the busiest so far this year for new listings, with 8 IPOs and 2 listings via special purpose acquisition companies taking place. We have another 8 IPOs and 1 listing via special purpose acquisition company slated for this week, and those IPOs do include Vroom for today. Alexis?
Emily, one more for you. One thing that caught my attention this morning, Tiffany, out with earnings, and I think underscoring some of this froth we're seeing in the market, they noted sales in China were up big.
Absolutely. So that was definitely a highlight from this earnings result. And we do have Tiffany shares up 2%, even though the company swung to a first quarter loss and posted a 45% decline on the top line for its fiscal first quarter. Taking a look at those sales in China specifically, though, massive rebound. Those were up 30% over last year in April and up 90% over last year in May. So a big recovery that we saw after sales drops of 85% in February and 15% in March for mainland China. So Tiffany did say it's focusing on that geography in its recovery strategy. It also reaffirmed that it's going to be moving ahead with its deal to be acquired by luxury company LVMH. And that, of course, coming as reassurance for investors
developed over the years were used as well as they were used in this regard. And the fact of the matter is that really it was the first test of them, and the fact that they worked so well is just stunning. I've written to you about
You've been listening there to Treasury Secretary Steve Mnuchin talking with members of the Senate about the payroll protection program.
Though certainly thinks that the Fed has done a great job, Alex, and certainly stock markets have rallied significantly since the Fed started pouring that extra liquidity in. So in some ways understandable that we get a little bit of a pause before we get Jay Powell speaking a little bit later on. 7 p.m. London time is when that is going to come through, or that decision is going to come through. Very much on tenterhooks waiting for that. So the S&P taking a little bit of a breather today. The Stock 600 over in Europe taking a little bit of a breather. The dollar, though, is at a 3-month low. And in some ways, you can argue that is also part of the Fed's success story. We did see, obviously, that in
Hong Kong government for Cathay, and do you think that it was the right approach?
Ladies, thanks for having me on. Given what's going on in the world, I don't think anyone is surprised by the capital recapitalization of Cathay Pacific. And given the national and economic implications of the flag carrier, I don't think anyone's surprised that the Hong Kong government
This would weigh on the stock today, but I guess we were expecting something like this, and the stock is up by a fraction.
Yeah, so obviously this was expected because, as you pointed out, most markets were closed, and the retail industry in general has been hurting a lot from this. Still, the numbers were a bit weaker than analysts were expecting, so that's on the negative side. But maybe there's an explanation for the share reaction in that there is a clear sign of recovery. The company is maintaining its dividend policy going forward, and they're also being very clear about how they see the road for their strategy in the next few years based on the experiences they had over the last few weeks, which is basically online sales.
So their strategy, Rodrigo,
Their strategy seems to be invest, invest, invest. Pay dividends and pay money to invest. Are they taking advantage of low rates to fund this?
No, really, this is a company that doesn't really turn to debt markets and doesn't take debt on. They have very, very little debt. They have a huge cash pile. So that is not really the reason.
Good morning, everyone, and welcome to the first trade on Yahoo Finance for this Tuesday, June 9th. I'm Alexis Christophers, along with my co-anchor, Brian Sazi. Thanks so much for being with us today. Well, it looks like after yesterday's incredible stock market rally, investors are taking some profits today. We've got stock futures lower across the board. Dow futures now down about 1%. But the real story here is the market's jaw-dropping gains, even in the face of an unprecedented pandemic and now civil unrest in our country. Since its low in March, the S&P 500 is up 44.5%. It is now positive for the year. The Dow up a staggering 48.3%. And the NASDAQ has rocketed nearly 45% to its first record close in about 4 months. And new data shows that it is the retail investor, not the institutional investor, who is driving this stock market rally. Investors seem to be unfazed by news that the U.S. officially entered a recession in February. The National Bureau of Economic Research said the economy reached a peak in February, marking an end to the longest economic expansion in post-World War II history. But the group said the downturn may actually turn out to be briefer than past recessions. Jared Blickery joining us now for a closer look at the stunning stock market performance. And Jared, I also want to bring to folks' attention that in another positive sign, the rally is not just concentrated in those big name tech stocks. There's sort of been a breadth to this market rally. Tell us why that's so important.
Yeah, that's a development that just started happening about 17 trading days ago, and that was the beginning of this latest leg up. And if we look at a chart of the S&P 500 year to date, I can illustrate what we're talking about here. Now, the first leg of this rally off the lows was largely driven by tech, the mega caps that we talk about, the FANG stocks, and not a lot of participation, a lot of broader participation. And then we kind of went sideways in here for about a month and a half, and it looked like the market wanted to roll over. But then all of a sudden, we got these cyclicals and value stocks like energy stocks, industrials,
Putin's actions annexing Crimea and similar views on NATO and sanctions.
Secretary Clinton
Good morning, everyone, and welcome to the first trade on Yahoo Finance for this Tuesday, June 9th. I'm Alexis Christophers, along with my co-anchor, Brian Sazzi. Thanks so much for being with us today. It looks like after yesterday's incredible stock market rally, investors are taking some profits today. We've got stock futures lower across the board. Dow futures now down about 1%. But the real story here is the market's jaw-dropping gains, even in the face of an unprecedented pandemic and now civil unrest in our country. Since its low in March, the S&P 500 is up 44.5%. It is now positive for the year. The Dow up a staggering 48.3%. And the NASDAQ has rocketed nearly 45% to its first record close in about 4 months. And new data shows that it is the retail investor, not the institutional investor, who is driving this stock market rally. Investors seem to be unfazed by news that the U.S. officially entered a recession in February. The National Bureau of Economic Research said the economy reached a peak in February, marking an end to the longest economic expansion in post-World War II history. But the group said the downturn may actually turn out to be briefer than past recessions. Jared Blickery joining us now for a closer look at the stunning stock market performance. And Jared, I also want to bring to folks' attention that in another positive sign, the rally is not just concentrated in those big name tech stocks. There's sort of been a breadth to this market rally. Tell us why that's so important.
Yeah, that's a development that just started happening about 17 trading days ago, and that was the beginning of this latest leg up. And if we look at a chart of the S&P 500 year to date, I can illustrate what we're talking about here. Now, the first leg of this rally off the lows was largely driven by tech, the mega caps that we talk about, the FANG stocks, and not a lot of participation, a lot of broader participation. And then we kind of went sideways in here for about a month and a half, and it looked like the market wanted to roll over. But then all of a sudden, we got these cyclicals and value stocks like energy stocks, industrials, the financials for that matter, all driving higher. And so this latest leg, 17 days old now, 17 trading days, has seen broad participation. And it is fitting that the very day that the S&P 500 goes positive, albeit only by 5 basis points, we found out that we were in a recession, but not a lot of big news there. And just looking at the sector performance over the last 17 days in this leg, we can see energy up 30%, financials up nearly 30%, along with industrials, real estate, staples, and a discretionary. And then to the downside, healthcare has been lagging along with the tech sector. We see it's only up about 11%. Now, can the market go higher? Of course it can, but it looks to be a little overbought right now, and we have that big Fed meeting tomorrow, so we might be taking a pause right now.
And Jared, we're seeing these retailers continue to rally. JCPenney, which is now bankrupt, their stock up 96% yesterday. Yet Macy's stock continuing to rally. You know, they came out with a new debt raise, but still the retail rally is strong.
Yeah, this is one of those signs of froth that we're seeing right now. I've compiled a heat map of a bunch of companies that have either declared bankruptcy or have been rumored to be about to, and you can see the performance. This is one-day performance as of yesterday. Hertz up 115%. Chesapeake, an energy company, up 182%. Whiting Petroleum, which has been in bankruptcy for months, up 150. JCPenney here, up 95. And if we look over the last 5 days, we can see this latest surge is just absolutely stunning. Hertz is up over 500%, for instance. But if we add the pre-market quotes to these, we can see that there is a lot of profit taking right here. We can see Chesapeake is already down 47% in the pre-market.
Yeah, thanks, Jared. Stunning is definitely the word. And, you know, and another sign that this market is really coming back to life, the IPO market is showing a lot of momentum. It looks like we're getting new S1 filings just about every day. Emily McCormick has been keeping an eye on this. And Emily, today the spotlight belongs to Vroom, the online automotive company. I understand they priced their IPO at the high end of the range last night. What else can you tell us?
Absolutely, Alexis. So we are seeing a renewed appetite for newly public companies recently, and Vroom is no exception. So we had that online car retailer pricing its IPO yesterday. That was actually 2 days earlier than initially planned, given this recent rush to hit the public markets. So Vroom's was an upsized IPO, with the company selling more than 21 million shares for $22 each and raising a total of $468 million. This was upsized, as I mentioned, since Vroom had earlier marketed 18.75 million shares for between $18 and $20 a piece. Now, following this offering, the company is valued around $2.5 billion. Taking a look at the financials of this company, Vroom is unprofitable but growing on the top line. It posted a net loss of $41 million on sales of $376 million for the 3 months ended March 31st. That was wider than the net loss of $27 million in the same period last year, although sales were also up 60%. Vroom mentioned in its prospectus that it's expecting the COVID-19 pandemic will encourage customers to buy cars, especially using online platforms to maintain social distancing. And those shares are expected to begin trading today on the NASDAQ under the ticker symbol VRM. And the last thing I want to point out is that we have seen a major uptick in initial public offerings and other listings over the past couple of weeks. Last week was the busiest so far this year for new listings, with 8 IPOs and 2 listings via special purpose acquisition companies taking place. We have another 8 IPOs and 1 listing via special purpose acquisition company slated for this week, and those IPOs do include Vroom for today. Alexis?
Emily, one more for you. One thing that caught my attention this morning, Tiffany, out with earnings, and I think underscoring some of this froth we're seeing in the market, they noted sales in China were up big.
Absolutely. So that was definitely a highlight from this earnings result. And we do have Tiffany shares up 2%, even though the company swung to a first quarter loss and posted a 45% decline on the top line for its fiscal first quarter. Taking a look at those sales in China specifically, though, massive rebound. Those were up 30% over last year in April and up 90% over last year in May. So a big recovery that we saw after sales drops of 85% in February and 15% in March for mainland China. So Tiffany did say it's focusing on that geography in its recovery strategy. It also reaffirmed that it's going to be moving ahead with its deal to be acquired by luxury company LVMH. And that, of course, coming as reassurance for investors who had been concerned over some recent reports that there might be some jeopardy surrounding the deal because of disruptions related to the pandemic. So again, we are seeing Tiffany pop in pre-market trading sharing some of those year-to-date losses, given some of the green shoots from this report.
All right, Emily.
Brian and
Thanks so
Alexis.
much. Let's stay on the retail beat here and bring in Tom Belger overseas. Tom, UK retail sales coming back just a bit. They're not surging like what we saw at Tiffany, but the recovery looks to be on their way.
Yeah, hi, Brian. I think everyone knows lockdowns pummeled retail stores, but it does seem like the worst is over. We saw figures out today showing total sales about 6% down in May. That is the second worst since records began in 1995, but it's infinitely better than the 19% drop that we saw last month, or the month before even. And there are some strong growth areas, it's worth saying. Online sales up 60% year on year in May. That's not even including food. And analysts don't think that those are ever going to fall back to pre-COVID levels. Food sales also spiked with workplaces and restaurants closed, and equipment for home offices, fitness, DIY, all of those selling well. And even clothing and beauty sales, interestingly, also up, with people now allowed out to go and meet friends and the like in public. And the big question now, how much demand is there going to be once non-essential retailers open their doors from Monday? That's the big shift we're going to see here in the UK. And can they actually survive as the government starts to taper off their support for those firms? Brian.
Hey, Tom, I know in addition to tackling COVID-19, Britain now trying to strike some of these post-Brexit deals. Talks have already started with Japan. What can we expect there?
Yeah, it's worth saying, oddly enough, Britain already has quite a strong trade deal with Japan. It's one signed by the EU in recent years. So what Britain's frantically trying to do with Japan and other countries around the world is let us keep and improve those existing trade deals when the Brexit transition ends in 2021. Ministers said all of that would be done by next year. That hasn't happened. Some countries sent a chance to extract some proper concessions from the UK. Japan, though, does look promising. Trade talks kicking off today. They're a major trading partner already, big investor in the UK, relations pretty good. But Japan's desire to lower car tariffs, that might prove one stumbling block. Reaching an agreement this year also looks quite optimistic. And lastly, far more UK firms are worried about progress in EU talks than they are about trade deals with Japan and other countries around the world. And those talks are looking pretty dismal. And we're looking dangerously close now to a no-deal exit at the end of this transition period in 2021.
All right, Tom Belger in London for us. Thank you. And today, the Federal Reserve kicks off its two-day policy setting meeting. Here to talk about what we can expect is Winnie Caesar. She is Wells Fargo's head of credit strategy. And Winnie, I'm going to ask you to please unmute right here in the Hangout. And I'd love to ask you about interest rates. They're pretty much at zero right now, but some even within the Federal Reserve are calling for an unprecedented move, negative interest rates. How likely do you think we are to see that scenario play out?
We do not have that as our base forecast. I think that many in the Fed are very hard pressed to see the efficacy of negative interest rates. We have seen interest rates go negative in other regions of the world. And we haven't seen a really direct flow through in terms of economic support. And we have to remember that the Fed's key targets are employment and inflation. And I think it's pretty easy to make the case that negative interest rates are not necessarily going to stimulate anything related to getting those two targets kind of back on track. Now, while we don't expect rates to go negative, we do think that we are in a very low yield environment in the near term. And we are looking for any commentary in terms of yield curve control, because as a corporate credit strategist, we're really looking for steeper curves. Steeper curves are generally where credit can generate the best performance. We've seen some curve steepening, particularly out on the long end, but we would like to see that trend continue.
Winnie, how dovish do you think Fed Chair Powell will in fact be? It's no small surprise. We've seen this market rally into this Fed meeting, I think, on expectations that the Fed Chair won't just sound dovish, even though he has been dovish, but even more dovish.
He's walking a really fine line right now because we have seen a tremendous rally across financial markets, very much predicated on the Fed coming in with unprecedented support in a very quick timeline. Effectively, the Fed put is now alive and well across pretty much every financial market. So while I think that he has to manage expectations in terms of economic rebound and the forecast for unemployment, the forecast for inflation rates, he also has to be a little bit cautious on the rally that we've seen in the markets. And historically, we've seen the Fed kind of target specific asset classes as ones that they are monitoring for signs of asset inflation and bubbles. And so we will be looking for any sort of commentary tomorrow regarding any specifics where they think that the market has gotten a bit ahead of what the economy is implying and really what the Fed is willing and able to do in the broader support of financial markets.
Winnie, what do you make of today the Fed announced it's going to be changing the terms of its Main Street lending program, which actually has not kicked off quite yet, but it's about to. It's lowering the initial stated minimum loan, raising the maximum that can be borrowed. Some had thought coming off the heels of that better than expected jobs report on Friday that the Fed might start to ease some of these programs. We're seeing just the opposite. Is this the right thing, what the Fed is doing, do you believe?
I think that the Fed's ultimate goal is to provide liquidity to institutions and entities that were solvent heading into this crisis. And there is a wide swath of U.S. businesses that were not necessarily included in the initial Main Street lending facility. And I think that they have been working very closely with people at financial institutions, at banks, talking about, what do your portfolios look like? Where do we need to be providing liquidity? Now, what the expansion does not do is provide a liquidity bridge for companies that were already very highly leveraged, particularly sponsored backed companies heading into this crisis. So I think that the expansion has been very focused on specific segments of the economy that need short-term liquidity bridges, but they are not necessarily those segments of the economy that were already stressed heading into the pandemic.
Winnie, do you think what you've seen from the Fed, and look what the market is doing here. We're seeing bizarre moves in bankrupt companies, valuations look frothy, at least to me. Have they sowed the seeds for a bubble? And that bubble can burst at any small word from Powell over the next couple of months that might sound or might be interpreted as hawkish.
I do have some concerns about the massive move in distressed equities that we've seen over the past week or so, and also the move that we've seen in CCC credits. We have a pretty aggressive default expectation over the next 12 months. And I don't think that the Fed's intervention is going to fully eliminate that default cycle. It may make it a bit shorter in duration, like we saw in the 2008 crisis, but it's still going to be pretty deep, especially given that getting the labor market back on sides, getting the consumer spending again is going to take some time. So, I think that you really have to look at across the financial universe and start to really critically think about relative value. I look at CCC spreads, and they are now showing that they have had the least widening on the year in the high yield market compared to double Bs and single Bs. I think as a high yield investor, you would probably want to be putting your capital to work a bit more up in quality, given that the uncertainty associated with the outlook for the economy is still pretty severe. And the Fed has not come in to say that they are going to buy CCC bonds directly. Now, the rising tide lifts all ships of central bank intervention and unprecedented policy easing is something that you have to keep in mind. But I think that as we see retail money flowing into specific parts of the financial markets, you have to think very critically about, who those investors are, whether they're just chasing returns and chasing yields, or whether they're thinking critically about actual credit analysis.
Winnie Caesar, Wells Fargo's head of credit strategy. Great to see you this morning and great insights. Thank you.
Thank you.
And stay tuned to Yahoo Finance. Coming up on the ticker at 2 p.m. Eastern tomorrow, we're going to get the Fed's new policy statement, followed by a press conference with Fed Chair Jerome Powell at 2:30 Eastern. That is happening tomorrow, again, on the ticker on Yahoo Finance. Coming up next, we're going to hear from Dr. Fauci on the latest about the coronavirus. Stay with us. Despite progress being made, we are still seeing an uptick in coronavirus cases. There are now 7.13 million confirmed cases of COVID-19 globally. That has led to nearly 407,000 deaths. Here in the U.S., we now have 1.96 million cases of the virus confirmed, causing 111,000 deaths. Anjali Kemlani is joining us this morning. And Anjali, I know the World Health Organization sort of backtracking what it had first said about folks who were asymptomatic. They're now saying that those people are not driving the spread of the virus. And I know just a short while ago, you sat down with the nation's top infectious disease expert, Dr. Anthony Fauci, and asked him about that. There seems to be some conflicting information out there. What did he tell you?
That's right, Alexis. So I guess it would be described more as just new information and a broader understanding of differentiating between asymptomatic and pre-symptomatic and symptomatic people. So there's just a lot of nuance that needs to be extracted. And that's what Dr. Anthony Fauci did manage to explain to us. So listen to what he had to say.
I think a lot of confusion has emanated from this issue of an asymptomatic person and asymptomatic transmission. When you look at the number of people, if you look at all the cases of coronavirus infection, about 25 to even up to 45% of the people are asymptomatic. The real question is, what is the percentage of infections that go from an asymptomatic person to an uninfected person? And that's something that we know it occurs, but we're really not sure exactly what the extent of it is, because it's very difficult to measure that. You can determine how many asymptomatic people are merely by doing screenings and finding out. But when you're doing epidemiology, so what the WHO said yesterday, that although there are asymptomatic infections and although asymptomatic people can transmit, they are not the drivers of the outbreak. The drivers of the outbreak are people who are symptomatic and transmit to others. That doesn't mean that asymptomatic transmission doesn't play a role, but it isn't the major driver of the outbreak. And yet there's this confusion when people talk about who's asymptomatic infection and who's driving it. But that's really what the WHO meant.
Okay. And talking about confusion, one of the things that I'm sorry I have to ask you about is hydroxychloroquine. The retraction of that study in the Lancet last week, which caused the World Health Organization to pause their trials, was based on questionable information. So I'm curious, has that changed your opinion of it at all? I know you've called for more trials. And is there a difference between, the treatment version, treatment option, or the way the president is using it as a prophylactic?
Right. The answer will come with the clinical trials. I think there's a lot of back and forth about what is a good trial, like the one that was retracted or not. I think the important thing for us all to do is that I've said for so long and so many times is that the definitive proof whether something is safe and effective, whether it works or not, is a randomized controlled trial. Those trials are being conducted, and we will know the answer, and we will go with the science rather than going back and forth in things that are sort of suggestive but not necessarily definitive. As scientists, we want to go with the definitive trial.
Just talking about making sure that we stick to the data is what Dr. Fauci was focused on, Alexis.
Did he say anything at all about a vaccine, Anjali?
Yeah, so he pretty much stuck to being cautiously optimistic about getting one this year. But I did ask him to explain what that means for the general public. And he did explain that it is going to be very restricted because of the pent-up demand on who gets it first. So that's something that he did talk about, as well as whether or not, we have to worry about vaccine nationalism. And he doesn't see that as an issue.
All right, great interview. Thanks so much. And you can check the entire interview with Dr. Fauci on our website and also on the Yahoo Finance app. Stay with us. The opening bell right around the corner on the First Trade. Stock futures under a little pressure here a day after the S&P 500 erased its year-to-date losses and the NASDAQ closed at a record high for the first time in about 4 months. So, Jared, I guess no big surprise that we're seeing a bit of a pullback here today.
That's right. We've come a long way. As you said, at the open, the Dow has advanced 48% from the March lows. And we're also seeing the NASDAQ turn green for the year, reach all-time highs. And then the Dow is also advancing nicely as well. If we look at the world, we can see kind of a mixed session in Asia, but a lot of red in Europe, as well as the United States. Just taking a look at the Dow futures, we can see they're off about 280 points right now, off of their lows of the session, still down about 5% year to date. But just looking at some of the trends that we've been seeing over the last few weeks where we had value and cyclicals leading, that's reversing today. And so the big cap stocks are actually outperforming, although they're in the red right now. And just taking a look at our sector performance, we can see that energy, which was a high flyer yesterday, up 4.5%. It's down 3% in the pre-market. Real estate's down 3.5%. Industrials are down 2%. Also seeing that in the Dow, which we have JP Morgan is down 3% today after advancing 2% yesterday. And then also taking a look at Boeing, which was up an astounding 12% yesterday, off about 4% today. We're also seeing this reflected in the yield curve. We have the 2s, 10s coming back a little bit off of its highs, and the 10-year Treasury note is off about 6 basis points.
All right. Thanks a lot, Jared. And we'll be back with the opening bell live from the New York Stock Exchange right after this. The New York Stock Exchange will observe an 8-minute and 46-second moment of silence beginning at noon today to coincide with the beginning of the George Floyd. A new trading day has begun on Wall Street, and here are your headlines making the first trade front page. The funeral for George Floyd is scheduled for later this morning. Services will take place at the Fountain of Praise Church in Houston in about 2.5 hours. Activist Al Sharpton will be delivering the eulogy to the 500-person service before Floyd is buried next to his mother. Meantime, 5 states are holding primaries today, including Georgia, Nevada, and North Dakota. They're going to be relying heavily on vote by mail due to the pandemic. This can be seen as a crucial test run going into the presidential election this fall. And new details today on just how COVID-19 is spreading. Despite prior reports, the World Health Organization says that asymptomatic people are not spreading the virus as much as it had previously thought. The group reiterated that asymptomatic spread can still occur, although it is, quote, still very rare. All right, let's take a look now at the market action. We saw that futures were lower heading into this session, and the Dow is now off more than 300 points to start the day. Let's say good morning to David Nelson. He is chief strategist at Bell Point. And David, always good to see you. We're also joined by Jared Blickery and Brian Sazi. So David, just what do you make of this incredible ride, I guess I'm going to call it, the market's been on? I mean, yes, we're lower today, but this is after having clawed its way back from those March lows despite all of the challenges that the economy and the world is facing right now. Why are we able to rally?
It's pretty historic, and we can certainly debate, whether or not the rally has come too far and whether or not valuations have exceeded expectations at this point. But what isn't up for debate is the fact that we're here and we're above the 200-day moving average. We're actually starting to live there, and the slope of some of these averages is actually pointing north. The last couple of weeks, maybe the most astounding move that I've seen is this, rush from one side of the lifeboat to the other side of the lifeboat, dumping your COVID stocks, dumping those large cap secular growers to pile into financials, industrials, and some of the more cyclical names. Today, it's giving it back some at this point, but stocks are saying right now that this comeback, whatever it is real, and that we've likely seen the bottom.
David, I'll put this question to you. Do you think what we're seeing in the markets is the Trump re-election rally? If I count 6 months forward, which you all know the market likes to count six months forward, that brings us to December. And to your point, the economy is in fact coming back to some extent. Is the thesis here, economy comes back and somehow the president gets reelected and the tax rates stay lower?
The tax rate is a big part.
which is certainly different from prior to the pandemic. Brian?
Yeah, that much is for sure. And as for A, thanks so much.
Thank you.
The national conversation following the murder of George Floyd has revealed a stark reality. Black Americans are missing from most corporate C-suites. Right now, there are only 4 Black CEOs at Fortune 500 companies. And a survey conducted last June by the Center for Talent Innovation found Black Americans make up just 3.2% of senior leadership roles at large companies in the U.S. So why aren't American companies doing better at this at all? Let's bring in Janice Usare, and she's the founder of BWG Business Solutions. Janice has worked with companies like Papa John's, PayPal, Nordstrom on diversity issues. Janice, good to see you this morning. So why do you, as you work with these companies, you get in there and you understand what their operations are and their culture in these companies, why aren't they doing better?
Hi, Brian. Thank you so much. So I think that there are a lot of different factors, one of which being an unrealistic expectation of how long change actually takes. Companies bring me in typically to do workshops and trainings for employees, and there is this expectation that after the training or workshop is complete, that employees will be completely transformed. Most of the problem is that this is the first time I'm being brought into the organization. So if you're only doing a one time a year, one-off training or a workshop, it's not going to produce long-term effects or long-term results. So I think that there needs to be a lot more realisticness with what the training and workshops can actually do, and there needs to be more consistency on these companies' part.
You know, Janice, you actually came up with some real actionable things that companies can do to make their workforce, especially their C-suite, more diverse. And one of the things you are proposing is getting rid of that popular referral program, right? Oh yeah, look, my friend is really qualified. They'd be great for this job. And then the company typically gives them a perk for bringing that person in. You say we should get rid of that policy. Why is that?
Yeah, and thank you, Alexis. So the reason is because referral hiring typically leads to a homogenous group within the workplace. So if I am asked to refer other engineers that I know, if I'm a white male, there's a high likelihood that I know other white males that I can refer. So if the goal is to get a diverse group of people, referral hiring does the opposite and often causes a echo chamber of the same types of employees being hired and referred into the organization. So I think that and another problem, Alexis, is that a lot of organizations don't actually use their diverse referral hiring program that they have. So if you're having your diverse employees refer other diverse employees, but you're not hiring from that pool, it can leave employees kind of feeling like your words are not authentic.
Janice, how much measurable change do you think corporate America can make within the next year? You know, the fact is, a lot of the board members are very much entrenched. It takes time to get them booted off for whatever reason. It takes time for management teams to change. When does that change start to happen?
What we're seeing right now, Brian, is really exciting for me because I've been getting requests. I've been inundated with requests for racial equity workshops. So I think that talking about the issue is the first problem. When I'm brought in to do workshops, racial equity is typically what organizations don't want me to focus on. Usually it's emotional intelligence or something like microaggressions, but I see a lot of promise right now. And I think that understanding that it takes more than one workshop, and I'm not a huge fan of unconscious bias trainings. So it takes learning that you have to be doing multiple things. And I think that because this is the focus of the national conversation, that change will actually start to happen. And I think it was promising that earlier this year, Goldman Sachs said that they're not going to take a company public unless they have a diverse member on their board. So I think that once Goldman Sachs said that a lot of companies will start to follow suit.
Yeah, we actually had Katie Koch from Goldman Sachs on our show this week talking about just that and saying that they don't have a problem divesting themselves of companies that they don't believe are doing the job when it comes to diversity. But I want to get your take on what we're seeing happen right now. Lots of companies very publicly saying they are giving millions of dollars to social justice programs as we see civil unrest in our country once again. Is that the right message? Should they be using those resources perhaps to have change happen from within their own companies?
Yeah, and that's a great question, Alexis. I think that for a lot of employees, it seems like their companies are being a little bit inauthentic because while in one breath they're preaching that Black Lives Matter, in another breath their organization is not diverse and there's no diverse representation in leadership positions. So I think that a large part of it is that I'm really happy that this national conversation is happening, but what is really going to take changes is putting that money into things like mentorship and sponsorship programs, because there's research that indicates that for diverse employees, mentorship and sponsorship in particular helps with their career progression. So in addition to workshops and trainings and things like that, also investing in your employee resource group. A lot of times when I'm brought in to speak to a company, it's through an employee resource group. However, they tell me that they don't have a lot of funding and that they have a very small budget. So if you have an employee resource group, making sure that you're also giving them adequate funding so that they can bring people into the organization to have keynote talks and to do events and things like that. So I think that half of that money should be invested in these nonprofits for racial justice, and the other half should be, it's important to make sure your house is in order before going out and trying to fix other people's houses.
Janice, we were just talking about lots of companies refusing to put out their diversity metrics. What's your advice to those companies that are still not doing so? Isn't it better to finally rip the Band-Aid off here, get it talked about on social media? It may hurt, and it should hurt, but isn't it time now to drive change, get those numbers released, and do a better job?
Yeah, definitely, Brian. So that was my main qualm with a lot of these tech companies. Every year since 2015, the Googles and all of these large tech companies have put out a diversity report. But what you don't see is they show you the turnover numbers and they show you the how many people are currently in their organization in diverse groups, but they don't show you whether those people actually stayed the following year. So people want to see that. And like you said, Brian, it's important to just rip the Band-Aid off because the public likes transparency. If you make a public statement and say, you know what, we haven't been getting diversity and inclusion right in the last few years, but we're committed to making changes here in an effort to be transparent. Here are our numbers and our percentages. The public would appreciate that. And while they would receive some criticism, it shows that they're authentic and that they're trying to make a change. I think that the secrecy is what bothers people, especially the employees who know what the company culture is actually like.
Really well said there. Janice Ghassem-Usare, founder of BWG Business Solutions. Good to speak with you this morning. Very important work you're doing.
Thank you so much, Brian, and thank you, Alexis.
All right, do stick around. We'll be right back with much more on the markets on the first trade. trade. Let's get right to Inez Ferre for a look at several stocks. Inez, Hertz has been on our radar screen for the past week. Wild moves in this stock.
Wild move, some profit taking as a reversal over the last couple of sessions. But take a look at Hertz right now. It's down 19%. It had been halted for trading earlier due to volatility. Yesterday, it was up more than 100%. And really, the movement, as you said, over the last week has just been incredible. It had reached a record low at the end of May of 56 cents a share. And you can see the movement since then. So just taking a look also at Chesapeake Energy, that stock has also been halted for trading. This is news pending, and Bloomberg has a report out that perhaps the company is preparing to file for bankruptcy. Year to date, the stock is down 57%. And then looking at Sorrento Therapeutics, that stock is up more than 6%. Yesterday was up as well on hopes of the company working on a drug to inhibit the development of coronavirus called COVID Trap. It's a protein to bind and block the virus. So Sorrento today seeing a pop. Brian?
All right, thanks so much, Inez. Across the country, America is moving forward with reopening plans. Meanwhile, states like Florida, Arizona, and Texas are seeing a rise in cases of COVID-19. Here to discuss if America is prepared for a second wave is Bob White. He is Medtronic's Minimally Invasive Therapies Group President. Bob, good to see you this morning. I know I've been following Medtronic for a while, and I know recently the company has ramped up ventilator production. How many ventilators are you producing in June, and how much are you looking to produce into the end of the year?
Brian, great to have you. Great to see you. Thanks for connecting with me this morning. You know, Brian, this is an unprecedented time, and Medtronic is mobilizing not just across ventilators, but other devices that really help in this COVID. So if you think about it, Brian, we've increased ventilator production fivefold. We will have gone from 200 a week to over 1,000 a week by the end of June.
Rob, what did you learn from the first wave? I mean, we know that there was a cry for PPE, there was a cry for ventilators, and then it wound up that some cities, actually New York City, which was seen as the epicenter here in the U.S., having more ventilators than they actually needed. So what did you learn from the first wave that is helping you prepare for a possible second wave at Medtronic?
Yeah, Alexa, thanks for the question. It's good to see you. You know, when we think about what we've learned, we think about it in terms of three big learnings. One is the ramping, as I just spoke with Brian. Our ramping of ventilator production is absolutely important. Second, though, is we've taken unprecedented steps to share our intellectual property. For example, we on March 30th shared our intellectual designs for our PB560 ventilator, and we did this around the world. And so if you think about this, Alexis, we've had over 200,000 access to our website to download this important ventilator documentation, because we don't believe that any one company can solve this epidemic or this pandemic alone. And so we've taken this unprecedented step, and that's opened up really unique partnerships with people like SpaceX and Intel, as well as Foxconn and the Vin Group in Vietnam. Because to answer your question about preparing for the second wave, we want people to be prepared. And then, Alexis, you mentioned New York City, and I think the Javits Center is a great example, right? Whoever would have thought that that convention center would have turned into a field hospital? But when we got a call from Governor Cuomo's office to install patient monitoring remote equipment, we installed 400 patient monitors over the Easter weekend. And the nice part about that, Alexis, was those 400 patient monitors can be managed by only 10 clinicians. And I know both you and Brian have healthcare workers in your family. And so the ability to protect those healthcare workers from infection and use less PPE is really important. So look, we're proud to do our part.
Bob, how prepared, just from a pure ventilator standpoint, is the government? Should we do get a second wave? What does the stockpile of ventilators look like in this country? Because you're no stranger to this. These ventilators have been shipped out to states for months on end here.
Yeah, you know, Brian, when we played our part to do the allocation, we thought it in three simple ways. You know, we thought, let's be ethical, let's be clear, and let's be practical. And ethical means let's take the ventilators to where they're needed most around the country. So, you know, we feel good in terms of not just our role, but other ventilator roles to ensure that cities and towns have the ventilators they need. Secondly, you know, the allocation method needs to be understandable. And we've shared that with the task forces both at a state and a federal level to ensure that ventilators are, put where they're needed. And then thirdly, of course, it needs to be practical so you can manufacture where needed. So Brian, as we look at the waves of how the virus is going to come back potentially in a second wave, I believe the country's well prepared, right? And now people need to continue to do what I trust you, me, and Alexis are doing, which are good social distancing, do all the things that we should do, and I think we can control it.
Yeah, Bob, talk about social distancing. You're not even in our studios today. But I know Medtronic just does not make ventilators, and you have been, the company executives have been presenting at various conferences of late. You operate the second largest business at Medtronic. What does your pipeline of product innovation look like for the rest of this year? Because yes, you are making ventilators, but you also have to get other new technologies out.
That's right, Brian, and thanks. And for the audience, the minimally invasive therapy group is about a $9 billion operating group inside Medtronic, so roughly about a third of Medtronic, and our 30,000 employees represent about a third of Medtronic's worldwide 90,000 employees. And you're right, Brian. We've got the most exciting pipeline in the company's history right now, and it's because we believe we're providing technologies that make a difference to clinicians. Both ventilators we talked about, but also patient monitoring equipment. Again, I think this remote monitoring of patients will become more and more important as people move on. And then, of course, we have a very large surgical business, and the role of open, minimally invasive surgery, very, very important. And so we're excited about the pipeline, and we think because it matters to patients and clinicians.
All right, we'll leave it there. Bob White, Medtronic's Minimally Invasive Therapies Group President. Good to see you. Hopefully next time we'll see you in the studio.
You bet. Thanks, Brian. Thanks, Alexis.
All right, do stick around. Much more here on the markets, and we'll also speak with the CEO of Elf Beauty, Tarang Amin. Stay tuned. All right, welcome back to the first trade on this Tuesday morning. I think it's Tuesday. I don't know. After a while, these days start to mix together. I want to take another look at a company that we're watching closely here, Yahoo Finance, and just Nikola. Inez, this stock is on fire. We talked to the founder last week, Trevor Milton, as it debuted on the NASDAQ, up 100% today. What's it looking like today?
Well, right now it's down just 1%, but as you just mentioned, take a look at the 2-day chart. You can see up 100% over the 2-day chart. This is the electric and fuel cell powered truck company, which debuted on the NASDAQ last week. And CEO Trevor Milton yesterday tweeted about reservations for the most badass zero emission truck starting on June 29th. So this may be part of the reason why you're seeing the stock surge, why you saw that stock surge yesterday. He also tweeted, "I wanted to say this my whole adult life. Nikola is now worth more than Ford and FCA, Fiat Chrysler, nipping on the heels of GM." So tweeting a lot about the company, a lot of enthusiasm about this company. And Brian, I would have to ask you also, do you think that this is investors chasing another Tesla-like stock?
Ooh, Tesla. I mean, Ned's talking about putting the hardcore questions to me. Certainly could be. What this company does, it's pretty mind-blowing. Interesting technology, strong design, and the fact of the matter is there is only one Tesla out there to play. And here's potentially...
By the way, Tesla's at an all-time high today. I don't know if if that's a little bit of the Nikola enthusiasm seeping over into Tesla, but that stock continues to move higher.
All right, well said. It is an electric car rally, but from electric cars to cosmetics, the cosmetic industry certainly saw a slowdown in the wake of COVID-19. But with states opening back up, folks may just be out there buying makeup again to support their selfie-taking habits. Elf Beauty CEO Tarang Amin is here to discuss. Tarang, always good to see you here. Look, I'm going on the streets. I'm wearing my mask. I see people wearing their masks. How is that going to impact the makeup industry's comeback over the next couple months?
Well, Brian and Alexis, thank you for having me again. I would say, in the beginning of the COVID-19 pandemic, we certainly saw a contraction in the category. The overall category is down at something like 38%. Even e.l.f. was down for those first 4 weeks, about 30%. But since then, we've seen a major uptick. And I think this has to do with, in the beginning, consumers prioritizing essentials, but eventually people want to get on with their lives. And we've seen really great results. I think today, some analysts published Nielsen data through the end of May, and our consumption was up 17%. Now, part of that we think is due to the stimulus checks, but I think it's a good sign.
specialist. And Georgia had a lot of problems yesterday. There were only 2 states, but we've seen this problem in Wisconsin and in Nevada and in Georgia and some other places where they're trying to, in Georgia, part of the problem was they were trying to set up new voting machines, but also they didn't get the voting machines in place, and there weren't as many poll workers because the elderly people who are usually there to take your ballot are staying home because they're afraid of the virus. And so there were these very, very long lines. And in Atlanta, black turnout was very high, probably because of the protests, and some of them had to wait in line for 4 hours to vote. And it's already pretty toasty in Georgia, so that was very unpleasant.
Yeah, exactly. Well, one of the big issues is going to be for November, how are we going to vote at all? Are we going to get to vote by mail, which is something the President of the United States doesn't particularly favor? Thank you so much to Wendy Benjamin. She's our political editor reporting from D.C. So that's going to do it for the first hour of Balance of Power, but we're going to continue for a second hour on Bloomberg Radio. We're going to be joined by Neil Bradley, Executive Vice President of the U.S. Chamber of Commerce. We're going to talk with him about Steven Mnuchin, the Treasury Secretary's statement, we need more fiscal support even though we're on a rebound. That's coming up on Balance of Power in the second hour on Bloomberg Radio. I'm David Weston. Thank you for joining us.
Hundreds of thousands of new investors from essentially Robinhood and other trading platforms. Combining all that with the fact that there's not a lot of stock available because I hold a lot of it, and our big funders hold a lot of it. So like Fidelity, PSAM, BlackRock, all these guys, they're like our blue chip investors. So there's not a lot of people wanting to sell shares, and that's good and bad, right? The good is, it's supply and demand. This is why people buy shares back into companies. They want less supply and more demand, and that's what's going on right now with Nikola. And ultimately, it's all about the story. I mean, look, we're launching our Badger just in a few months, and I'll make sure you guys are there at that unveiling. That Badger is going to rock the world. And when we put that out there and let people know how soon it was, reservations open June 29th on that truck. It's going to beat every pickup truck that I know of in the market, and we're going to do it in front of the audience. And I think that's really what you see with Nikola right now is we're actually delivering products, and it's been pretty incredible.
Trevor, it really has been. We're happy to hear too that you get a lot of your information from our website, Yahoo Finance. Look, you're forecasting zero revenue for 2020. You're not expected to be $1 billion company until 2023, yet the market's valuing you right now at $26 billion. As wonderful as all this euphoria is, are you concerned a little bit that the market is getting ahead of itself? Because you don't want to be one of those stocks that has this spectacular debut and then sort of crashes and falls. Are you concerned at all about that?
I mean, the most important thing you can do is give good, long, steady growth in a company. It's what everyone hopes for. No one likes volatility going up or down, right? Like you want good growth. But you can't control what people do. I mean, I'm not going to go out there and tell people our company is not at the right value, because honestly, I think our company has much more value to go. But at the same time, you can't control. I mean, if people are excited about Nikola, they're excited about it. I don't like volatility. Nobody does. But the most important thing I can do is hit every benchmark I tell people we're going to do. Be very open and communicate with all the followers on Twitter. You can follow me at Nikola Trevor on Twitter. I'm very, very active. I'm probably one of the most accessible and direct CEOs. Well, I'm now the executive chairman of Nikola Corporation anywhere in the world. And I think that's a big reason why people love Nikola. They want to know that they can talk to you, that they can relate to you, that you're not some dude sitting in the office, making tons of money while the rest of the people suffer. And it's just not how we are here at Nikola. I'm very open. I'm connected. Even people bashing me, it's okay. Like I get it all the time, and I kind of make fun with it with them. And that's the difference between Nikola and everybody else.
Trevor, I'm confused why you don't follow Alexis now yet, hopefully after the show. But you mentioned the Badger is coming out. I do sense the excitement out there in the marketplace. What do the orders look like that? Are you taking orders? I'm just a little unfamiliar with the buying process for you.
Yeah, so this is why there's so much excitement right now. June 29th, we open the order book for the first time for the Nikola Badger truck. This pickup truck can go 600 to 700 miles between charges. There's no other vehicle like it in the world. And so what we've done is we've not taken any orders until now, and we open them up on June 29th. So the whole world is waiting for June 29th right now.
and made that recovery quite weak. By some measures, we were hit, and when it just overwhelmed everything. I mean, even I think if the economy had been doing a little bit better before the shutdown began, it still would have been a recession. I don't think you could have avoided this recession. But unlike causing a recession where you turn the economy off, hey, everybody stay home, close all the doors, lights on, everybody go back. It's all. And I think that will be reflected, and that's what we have to watch in these forward-looking indicators. The market is very hopeful that it's an 09-10 scenario. I don't have the.
You bring up a good point about, you can't just lagging data. That's a problem with the employment rates of people going back to those jobs if they might be at higher risk of then getting a second infection or maybe risking another outburst of the virus. So I guess when we're looking at, for example, on the other side of things,
I'm going to put words in the market, presents itself in leading indexes, in the leading indicators, right? The whole concept of a leading indicator is that you are not looking at just one section of the economy, but rather a broad swath. Hey, what's going on in the financial market? I think this, but just by virtue that, relatively speaking, went back to work, the recession will technically end this summer.
Lakshman, it's always good to see you. I miss running into you on the subway and look forward to a return to normalcy. All the best to you, sir.
To be continued. Thank you.
There were some changes that the Fed announced to its upcoming Main Street lending facility. Brian Chung follows the Fed for us. Can you help us understand what they're doing to make it easier to obtain those funds when they asked
yesterday in the afternoon, tweaking the thresholds for the types of loans that it'll offer, which will broadly make this lending program larger. So keep in mind, the Main Street lending program is designed to offer cheap loans to small to medium-sized businesses. Originally, the cheapest loan or the smallest loan that it was going to offer was a $500,000 loan. Now, the Fed made a change yesterday to lower that threshold to $250,000, and it also actually increased the higher end and the maximum loan size to as high as $300 million. It also changed the risk retention so that the lender, because the Fed is not going to be doing the actual lending itself, it will actually be contracting bank lenders to be actually originating these loans. That will actually only require 5% of risk retention. The Federal Reserve will take on 95% of the risk of these loans itself, hopefully to incentivize there to be more of these Main Street loans that are underwritten. And then actually changed the terms of the loans themselves as well. It was originally 4-year loans. Now they've extended that to 5-year loans. So the Federal Reserve making these tweaks to try to increase the uptake of this program, but we still don't have a specific launch date. Jerome Powell, the Federal Reserve Chairman, had said in the past that he was hoping to have it up the first week of June. The Federal Reserve announcement yesterday said that it would be forthcoming soon. Adam?
Let's continue this discussion with Lale Topcholo, who is the J.O. Hambro Senior Fund Manager and Head of Credit. She's joining us from New Jersey, and there's a great deal to break down in what the Fed is doing, Lale. Thank you for joining us. One thing in particular, because they've already launched the facility to, for instance, purchase ETFs. And help me understand why you think it feels like a bait and switch, and is it?
Sure. Well, good morning to all. When there were a number of facilities that were launched to basically help the corporates sector between the primary and the secondary. And then one of the things was when you looked at the primary corporate facility requirements, it's actually quite onerous. The onerous part being you have to certify that you're a U.S. entity. You have to certify that X percentage of your employees are U.S. based, which makes sense, right? It's a U.S. central bank that's providing liquidity so you can provide jobs in the U.S. It entirely makes sense. Now, in the meantime, they also said, oh, we'll also just help a little bit on the ETF side. Now, the challenge with the ETFs, and this is why I expected them to buy some when the facility was first launched, because you don't want to try it in the last minute and there's glitches, as we've seen with the repo glitch back a couple of months ago. That doesn't bode well. But what was interesting about the ETFs is they keep buying. The markets are functioning just fine. The high yield market is functioning just fine. The investment grade market is functioning just fine. The challenge with the ETFs is LQD, which is the one that they've been buying the most, has nearly 11 years in average maturity. The primary corporate facility limits it to up to 5 years. It has banks. 25% of that exposure is banks. It's financial services. Whereas in the primary corporate facility, banks are not allowed to be a part of it. And the high yield, and we can debate about the fallen angels part of it, I still think increasingly providing support for high yield does increase moral hazard. I don't believe it's the right thing to do. And I'll leave you with this note, this final thought on this is it's like giving a little kid, a treat if they eat a good dinner. After dinner, then the kid will always ask for, my 4-year-old does, can I have a treat? I ate a good dinner. The fact that now the corporates have entered into the Fed's buying power, it's going to be nearly impossible to erase that from the market's mind. The only way you can walk this back is now you have to slow down your ETF purchases aggressively and eventually stop it. So the market believes this is one-time deal. Otherwise, I think you've just made the moral hazard permanent.
Lale, it's Brian Chung here, and you bring up a good point. I think actually the Fed is even waffling with that idea too, because when the Fed originally designed this secondary market corporate credit facility, it didn't include fallen angels. They revised it to then add that. And as we saw from the granular detail from the Fed's most recent report, about 20%, I think it was actually 17% of its purchases were in high yield in those fallen angels that had fallen into that period of time after the Fed announced that facility. HYG, I think, is a big holding in there, over $100 million. I mean, why do you think the Federal Reserve is making such a substantial part of its purchases in high yield? And how does that kind of relate to, I guess, the stack here of corporate debt and what the Federal Reserve is trying to do in trying to, I guess, backstop that?
I think from the fallen angel perspective, the way I sort of thought about it is, some of the names where you can make a case, they had national importance, right? It was airlines, it was auto. You can make a case, national case for these. And that's how I rationalized. I said, okay, for the time being, they can give them support, and then we'll figure out based on the recovery. What is challenging about the high yield piece of it, one thing they could be concerned is because the corporate bond markets exploded, right? In terms of amount, like who owns it? We're in trillions now. We're 2x the amount we were in global financial crisis. So they were concerned that the growth was so rapid that there going to be some systematic risk that was going to be formed to the financial markets. The challenge with that is then you can never stop the markets running ahead. Then people will always swing the bat aggressively. We'll grow exponentially in derivative products and this and that. And then the Fed will come and bailing you out. Like when does it stop? And that's what I can't get my head around it.
Lale, it's Julie here. So as you try to trade all of this, do you hedge against an eventual pulling out by the Fed? In other words, what is the actual market risk? You talked about the moral hazard. What about the market hazard? I imagine it's not happening anytime soon because the Fed is not pulling back anytime soon.
That's the consensus view. The consensus view is you follow the Fed. So if the Fed is buying high yield, you just go buy high yield. Look, everybody's looking for a V-shaped recovery. Look at the retail ETF flows. That's your V, both in IG and high yield. Very substantial, very obvious V. So clearly there's momentum behind it. For us, for high yield, we haven't really ventured into high yield. We're sticking with investment grade because these are real businesses with high asset coverage that we think will survive the crisis. High yield, again, I've said this before, they become high yield by choice. There's a reason. They don't generate much free cash flow. They're very levered. So you're going to take substantial risk on the recovery on the economy. And despite what has happened in terms of the rally, I'm not convinced based on historical experience that you can divorce market fundamentals, company fundamentals from what's happening in the economy. Somebody has to be paying the bills.
Lale, I'm curious long term, because there was an article in the Wall Street Journal about the potential for the U.S. to lose its reserve currency status with the dollar. Is the Fed, if you want to weigh in on this, is what the Fed doing now setting us up down the road for that fact to happen? Because that'll raise the price of borrowing for everybody.
It's possible, but I don't know. I don't have a good answer for that.
And that is a short and quick response to the question I just asked. I appreciate that. Lale Topçuoğlu.
Nice try.
No, you did well. Thank you for joining us. And you should know that Lale is the J.O. Hambro Senior Fund Manager and Head of Credit. She assuages our fears when you see things in the Wall Street Journal along those lines. We're going to take a break, and we'll be right back after this. Welcome back to Yahoo Finance on the Move. We are awaiting shares of Room to start trading. We're also waiting for shares of Chesapeake Energy to resume trading. They were halted pending news. Everyone's waiting for news about the development of a coronavirus vaccine. And our Anjali Kemlani spoke with Dr. Anthony Fauci about those issues and many others. Here's some of what he had to say.
So first of all, everyone should understand when either I or other people talk about projections of vaccines, when you may or may not get it, you've got to realize there is no guarantee at all that we are going to have a safe and effective vaccine. We feel, and I'll use my terminology, cautiously optimistic that we will actually be successful. So we're counting on being successful. The rate at which we do it is something important. We say we're doing it very quickly and at risk. It isn't risk of safety. We're not compromising safety. We're not compromising scientific integrity. What we're doing is that we're going along at a pace where under the normal development of a vaccine, you would go to one step, wait to see if you're successful, then make an investment in the next step. Then when you're successful, make an investment in the next step. The reason for that is caution, because if you get stopped at this step, you don't want to have to waste all the money of the investment. Companies do that because they can't risk resources. Given the urgency of this situation, we've made a decision with the support of the federal government that we will proceed at risk. We will start making doses of the vaccine before we even prove it was effective. If it isn't effective and isn't safe, then the only thing that would have been lost is money. But we feel it's worth it to gain those extra months. And that's the reason why we're moving more quickly than usual, because when people hear quickly, they say, oh my goodness, are we compromising safety? Are we compromising scientific integrity? The answer is we're not. Given that, we project that we will be able, if we're successful, Anjali, and that's a big underlining, if we're successful, it is likely that we will have doses to be distributed to people by the end of this calendar year or the beginning of 2021.
Anjali, should we be concerned when he says, quote, cautiously optimistic? Because some of us hear that and think, we really don't know.
Well, it's funny you bring that up. I did actually point out to him that he does tend to say that really often. And so he says that he uses that when he's, as he said, really optimistic about it. He seems to be pretty confident that there is going to be at least one, if not many, indications of success by the end of this year. And what that means for distribution really is simply that by next year, it'll reach the general public. But right now, we're just focused on which ones will come out ahead.
Anjali, did you have the chance to talk to him about reopening and what his concerns are around reopening, as we're seeing now spikes in cases in places like Texas?
We didn't get a chance to talk about specifically the states, but we did talk about the protests actually, and the role that they play. And so one of the things he was saying is that, it's going to be impossible. There's no way to give the mandate not to protest. But when people do, to remember to wear masks, and even when chanting, there's so much of a crowd that using the safety procedures is going to be even more important.
Anjali, you're going to have stories posting on the webpage from this interview with Dr. Fauci, and I know that you're going to be hitting all of our programs throughout the day. What else is he saying about, once we get past this, if he brought this issue up, the next potential, virus that poses a threat to us? Are they even focused on recreating the infrastructure to protect us in the future?
We didn't get a chance to talk about that, but there were indications, when he was discussing about his previous experience, how this is sort of a very unprecedented situation. There hasn't been a playbook to follow specifically. And with all the efforts that you've seen from the national level, whether it's the ramping up of swabs, and the lab testing that's been increasing, even with that testing, he did say, they're much better than they were, even just by last month. And so he's pretty confident about the ability of the U.S. to respond.
Angelique Hemlani, we look forward to the various reports that we're going to be seeing from your interview with Dr. Fauci. All the best to you. And when we come back, going to put a little bit of gleam in your eye as we talk about gold. misconduct cases under federal court purview, should establish a federal registry of police misconduct. We see CEOs advocating for change, but here are direct steps that could be taken. Brian, I mean, are these the kinds of things that Congress will listen to when you hear it from someone like Mr. Krishna?
Well, I think the question here is really going to be, what's the play going to be for policymakers to either require or make companies do these types of things? And I think for right now, first of all, Congress is already trying to work through what might be a phase 4 of a COVID-19 related package of some sort. So the political capital there is already kind of in question for what Congress can do on these types of things. But largely, it seems like private companies have a big role to play here, as you mentioned, Adam, and as Julie was mentioning, even just with the facial recognition technology. A lot of these types of socially, I guess, induced trends when it comes to technology have a lot to do with how well monetized they can be done by companies like IBM or like these big tech companies that really drive the equities markets that we watch here on Yahoo Finance every single day. So independent of what Congress usually does, it's kind of all about what are these private companies doing in investing in these types of technologies to whether or not help law enforcement or even just for other players. Keep in mind that facial recognition technology, for example, is not necessarily something that's independently for police. It's also for companies like JetBlue or for Hertz, right? These are companies that have tried to incorporate facial recognition technology to speed up the check-in process when you're either boarding a plane or getting into a car that you've rented from an airport. So those are the types of economic drivers that create this onus for technology, but does raise the question, is that technology also being used for other nefarious reasons, which I think is something where that's where policymakers can kind of step in and draw the line.
Yeah, and I think to Brian's point about corporate America, you know, we have heard over the last several weeks great statements coming out of these companies, but I do wonder if there's increased scrutiny on where these companies are actually investing in. And this isn't just, I think, about the race and inequality issue. I think it's a lot of other social issues that, you know, we have heard companies sort of make these commitments before, only to turn their back once the issue has kind of subsided. And I wonder if there's going to be more increased scrutiny on the types of investments they make, the actual changes they are held to. And I don't think it's just a political issue anymore, especially because on the policy side, things have moved too slowly, which is where we got to where we are today.
Okay, well, this is certainly something we're going to keep talking about to reach the goals that all of us agree the country And welcome back to Yahoo Finance on the Move. We are watching gold right now. Gold had jumped more than 1% in early trading, and George Milling-Stanley is the chief gold strategist at State Street Global Advisors, joining us now to talk about gold. And very quickly, as we talk about the flows of money into gold, can you help us understand, most people understand gold as a hedge against inflation, but what about gold as a hedge against deflation? Because we're hearing disinflation and deflation of assets being talked about a lot these days.
Okay, so disinflation is the only thing that gold doesn't like. It doesn't like a gradual decrease in the inflation rate. But gold is a very effective hedge against sustained high inflation, which I would define as above 5% a year. We're nowhere near that, obviously, right now. And the seminal work on this, which was Professor Roy Jastrom's The Golden Constant, basically came to the conclusion. He found it rather counterintuitive, but he said even during periods of deflation, gold tends to lose value less rapidly than other assets. So it's a good hedge against sustained high inflation. It's a good hedge against deflation as well.
Hi, George. It's Julie here. It's good to talk to you. So as we have seen flows come into gold ETFs, like the months, I mean, already we've put the worst behind us.
I'm not sure I'm agreeing with those prognosticators who are suggesting that. We've seen a very, very rapid recovery in the stock market from the weakness in March when we first started to take COVID-19 seriously as a global pandemic. I think that recovery has been much too rapid. Stocks have been on a tear. They're now at another high for the year. They've been on a tear, and at the same time, the economy is in tatters. It's very clear. We got the official declaration that we're in a recession just yesterday. The second quarter figures are going to look pretty bad, even though people are beginning to take the first tentative incremental steps towards getting things moving again. I think it is perfectly possible to see continued inflows into the gold ETFs. We've seen more than 12 billion into GLD alone. I know that's the market leader, and that is the bulk of what we've seen. But that is really quite an amazing performance to take that product up to a $61 billion ETF. I think it is perfectly possible to see similar kinds of flows for the rest of the year. Maybe not quite as big as we saw in the first 5 months of the year, but I think it's perfectly possible to see them. I'm worried about.
George, it's Brian Chung here. So I know that it's similarities or differences between the way that investors are approaching gold in the recovery in response to 2008, 2009, and now.
Let's go a little further into history. 2008 is a very good example. We saw sudden dramatic fall in equities. People expecting gold to soar, and it didn't. It went down, but it only went down very briefly as people who owned some gold were able to meet their unexpected liquidity needs, especially if they bought stocks on margin and were facing calls for
especially since this is not the same kind of financial correction that we've had in 2007, 2008, or even 2001.
No, you're absolutely right. It's not. But I still think that the focus right now, obviously, is almost exclusively on COVID-19 and reopening and trying to restart the economy and so forth. But the gold was already moving up very rapidly, even last year. Last June, gold broke out above the top of a trading range that had been in place since the spring of 2013. So for a full 6 years, with gold being topped out at about 1,350. Because of all of the concerns people had then, gold was already above 1,600 before we ever heard about coronavirus in the early part of this year. And I think that those concerns are going to resurface when we lose this almost exclusive focus on the virus. I mean, those concerns were economic. People were very happy that stocks had gone up for 11 straight years, but they were concerned that we haven't yet totally abolished the economic cycle, so they were wondering when they were going to see a downturn. People were delighted that we just completed the first decade in the history of the United States that didn't feature a recession. But again, people were worried that there might actually be one. And we got the news officially yesterday that we are in a recession. So I think the outlook for equities is cloudy, even though they have been on a tear, and I accept they've been on a tear for a couple of months now since the recovery, but I think that they've gotten way ahead of themselves. I think Corona is highlighting the massive disconnect between the stock market and the underlying economy that everybody thinks it represents, when clearly it doesn't. The economy is in real trouble and the stock market is roaring. That just doesn't make sense to me. It doesn't commute.
Doesn't make sense to a lot of people. George Milling-Stanley is the Chief Gold Strategist at State Street Global Advisors. Thank you for joining us. We're going to take a break and check markets when we come back. Welcome back to Yahoo Finance on the Move, checking markets right now. We are watching a little bit of a sell-off on Wall Street. The Dow is off about 200 points. S&P 500 is down 20, off about 250 points. The NASDAQ, though, is positive, up over 17 points. There is a renewed discussion about helping people of color and disadvantaged people achieve their rightful place at the table, corporate boards and in corporate America. To help us understand how we can achieve that, Jeff Lindor is the Gentleman's Factory founder and chief executive officer. He's joining us from Brooklyn. Good to have you here, sir. And I am curious, what are we hearing now that is different than what we've heard in the past? And what might we be missing? Do you think corporate America is going to bring about the change that we've heard promised in years past?
Oh, well, again, thank you so much for having me. And what we're hearing now is dollars being allocated. Because before, it was a lot of, this is what we need to do, and, a lot of, just talk. But now that, we're seeing lots of different companies allocating dollars towards initiatives and pledging, right? So, we also need to see where those dollars go. But it's a good step in the right direction.
And Jeff, just to give a little background, the Gentleman's Factory is essentially a networking space and group for men of color. If I could ask you, the conversations, not just lately, but since you founded the Gentleman's Factory, what have been the biggest challenges for your members in terms of, be it getting funding or getting that job that they want? I'm just curious what the conversation has been, and if it is now changing, if you're seeing encouragement among your members.
Yeah, so, the challenge was always access and opportunity, so our members and Black and brown men all across the country, all across the world, have the knowledge, the skills, the ability to be in any room that they so please to, but it's a lot of unconscious biases for which, that's really what's been, hindering us historically. When it comes to our members, we have, men that graduated from Harvard Business School to guys from community college, right? So, we are really looking, to ensure that wherever we are in our career paths, that we are placed in a position to dominate and then also to scale, because we also need the same opportunities as everyone else.
Jeff, you talked about companies now talking about dollars and what they can actually do to sort of commit to moving the needle. But you've talked before about some of the startups, the success stories that have come out of your organization, and VCs traditionally have not funded a lot of these minority-owned startups. Have you seen that change at all? Are you getting more calls? What are you hearing on that side?
Oh, well, so, we're happy that companies are now pledging and saying that they're, pledging hundreds of millions of, $1 billion, et cetera. But now, we need to see exactly where that money goes, right? Because right now, there's protesting and, people are really upset and, everyone is saying Black Lives Matter. Then there's the pledge. But now we also need to see the results 6 months from now, a year from now. And then one thing that corporate America needs to understand and the world needs to understand is that Black and brown people can't unlearn what we've just experienced. So we've seen that within a span of 2 weeks, we literally moved the world. So if we don't see the results again, then they'll then now rally back up so that we could get the results, right? So it's good that there's pledges, but we're evaluating where we'll be 6 months from now, a year from now. And I believe that if the community is not happy with the satisfaction, then we'll be marching again.
Jeff, it's Brian Chung. You talked about access and opportunity for your members, but that's also a running theme, I believe, for minority-owned businesses as well. When it comes to getting credit, for example, Black-owned businesses have a harder time getting credit, have more financial challenges than the average small business. I guess I'm wondering, as a small business owner, what are some of the challenges that you've faced, and how are you getting through them, or advising others in your community that also own businesses to work through that issue?
Sure. So with the Gentleman's Factory, the beauty of it is that it is a community, so we have, hundreds of members in different spaces, from finance to banking, senior executives to guys starting up. So with what COVID did for us as a company is we've grown digitally now, right? So we have members in 14 states and in 4 countries. So now we're coming together, sharing resources, having conversation, and pulling our resources together. And that's what we've been doing historically, not only at the Gentleman's Factory, but, Black and brown communities all together. But now, although, we, are coming together, we also need corporate America to do their part, right? Because there's so many things that needs to be done. And we could do so much, and we're striving and we're pulling together because we are a resilient people. But I think that corporate America needs to step their game.
All right, Jeff Lindor from the Gentleman's Factory, the founder and chief executive officer. We look forward to your returning and as of yet. There is a concern that people will need cars and will rely less on public transportation because of the pandemic, and Vroom is up roughly 77% in its first day of trading. We're going to have much more for you after this. Welcome back to Yahoo Finance on the move. Vroom, vroom, vroom. Off to the races, at least for that stock on its first day of trading, but not so much the indices. Jared Blickery, what's going on?
Yeah, we did just see Vroom open up for trading for the first time, and just looking at the Wi-Fi Interactive, it's up 81%. Another indication of a lot of risk taking in this market right now, except the other markets, as you mentioned today, they're not really following along. We do have the NASDAQ in the green just a little bit, but the Dow, which has been leading over the last few weeks, down 1%, S&P 500 down 0.8%, and the Russell 2000, that is down 2%. And also looking at some of the other sectors that have done well over the last 3 weeks, kind of retreating as well. We're going to take a look at the Dow Jones Transportation Average. That's down 2.7%. But what's outperforming today, although it's still in the red, are the semiconductors, and that's coming off of a record high for that chip index. Let's also take a look at the VIX, because that is a little bit elevated today, but still well below 30. I think 24 was the low the other day. And we're also going to take a look at the bond market, because 10-year T-note yields are down 7 basis points. That's a pretty steep drop, something we haven't seen in a long time. They have been advancing by quite a bit, and that's been concurrent with the risk rally that we've been seeing in cyclicals and values, which is kind of reversed today. Now, the US dollar index is also lower, and we're going to take a look at a longer-term picture of the US dollar. Let's go to year to date, and we can see it's been down, I think, 8 of the past 9 sessions. And we do find support here at about the 96 level, but this is a pretty significant breakdown, which is good for risk markets, by the way. Also going to take a look at crude oil that is backing off of the $40 a barrel that we saw yesterday. First time we'd seen that since early March. Not any headlines in particular, but just taking a breather there. And then the metals complex is largely advancing. Gold futures are up. Interestingly, so are copper futures. This is a year-to-date look, and you can see we haven't been this high since March as well, Adam.
Real quick, I wanted to ask you about Chesapeake Energy, and they halted. What's really going on there? Have they filed for bankruptcy protection?
That is the story, but I don't think we have confirmation yet. You can see on the heat map here, it is unchanged. That's because it was halted before the open. It was down significantly in the pre-market. And we can see all these other stocks that are either in bankruptcy or have been rumored to be filing for it. They are off today. But if we take a look at the 5-day, you can see incredible returns there. Hertz up nearly 500%, JCPenney up 138%, just par for the course here in our topsy-turvy market. But I do want to get to our Yahoo Finance premium idea of the day, and this is Broadcom. Excuse me, that is not the Yahoo Finance premium idea of the day. We're going to get back there in a second here. Okay, Broadcom, and we're going to take a look here at a year-to-date chart. This comes by way of Argus Research, and they have a long-term price target of $350. That is just up here. And
Great to
that
know.
would be
We're going to take a break
high.
right now, Jared. I got to interrupt you. We're going to have more for you right after this.
This is On the Move on Yahoo Finance. In just a moment, we will be taking an 8-minute, 46-second moment of silence along with the New York Stock Exchange to commemorate the life of George Floyd and to coincide with his memorial service, which is about to take place in Houston, Texas. the globe to protest against my co-anchor Adam Shapiro now, and Senator the others who have, but specifically, what do you think?
Future course of events in a way that no one will ever lose their life like George Floyd did. And that means the standards for police misconduct, you should and should not do, and what you're obligated making some of their own proposals across the spectrum. Believe that these abuses exist and that they need to ultimately be reformed. So the voices of the people, I think, are going to drive. Just like the civil rights movement, there came a moment. The Voting Rights Act came a moment. I think this is a moment for the type of police reform we're talking about.
Senator Jessica Smith testifying before the Senate Finance Committee.
To you. I want to know from the Secretary, what's your plan for August 1st? When the enhanced benefits